we're going to talk today about innovations in market microstructure and how they've affected the world. I have a list of questions that I will start the discussion with, but we really hope that very quickly we'll get to your questions as well. By taking your questions, we will be certain that we'll be addressing issues that are of interest to you. So I want to start with a very quick observation. Practitioner and academic appreciation of the importance of market microstructure has increased very substantially in the last 30 years. And so my first question to our panelists is, what ideas developed over this time have been most important or influential to how the markets are organized, or how practitioners trade in the markets, or how regulators regulate those markets? So our panelists will speak, and then I'll interject a little bit as well, as I have some authority in the area too. So who'd like to go first? Perhaps Michail, as a practitioner, you've been very, very involved. What ideas have been really important?
In terms of, I think, in terms of ideas per se, even if you go back to 1985, this game theoretical approach of informed versus uninformed participants, that was seminal for me, and that is exactly how markets operate anyway, even to this day. I think the biggest innovations or changes that we've seen have been in terms of technology, in terms of speed, in terms of the tools that are being utilized, rather than being able to identify a singular idea that has changed the landscape. It's been more the behavior affected by the advent of technological advancements that were essentially not even feasible even a few years ago. There are many examples of market-related activity that I would have thought 3-4 years ago, when I heard people discussing it, that would not be possible, and now it is. So I personally cannot pinpoint a singular idea that has revolutionized things of what we do. It's a continuous evolution and advancement with new tools, new processes, new data sets that are available to make the market faster, possibly more efficient, but also attract different participants. So the environment has changed with a plethora of ideas being implemented.
In terms of time scope here, I think back to starting with Kyle's paper in 1985 as a base, and of course, the way we trade securities is totally different now than it was then. It's a different world. I agree that most of that really comes from technological change as opposed to academic work. My view of academic work on market microstructure, there's of course a close correspondence between academic work and practice and regulation. Larry, for example, is an example that a prominent academic who's also served on the as an economist at the chief economist at the SEC, and has served on boards as well. So there's a close connection. Now, people who make markets, people who trade, are, from my experience, smart people who have money serve as a very strong motivation to get things right. So how much do we have to tell them that they don't already know? If we talk about, say, adverse selection and the problems of trading with informed traders, as shows up in Kyle's model. Before I went to grad school, I was a retail stockbroker, and the traders didn't know anything about asymmetric information, but on the other hand, they had a rule for their quotes, when in doubt, spread them out. So they knew about asymmetric information, even if they couldn't put it into those words. So I think what academic research has done better than anything else is it's clarified and organize things. These guys that I knew couldn't give you a good explanation of asymmetric information. The academic literature provides that.
Yeah, I think that's exactly right. I think what Pete's 1985 paper did is give us a framework to think about the trading process in the financial market, and through that try to understand some of the most important variables about the functioning of the financial market, including price discovery, the extent to which information is revealed in prices and the process by which information gets into prices, and liquidity. Those are things that everyone talks about, but before you have a framework that puts a formula and can help you analyze it and see how it is going to change with different changes in the environment, it's very hard to do a precise job and to understand it very well. So I think this is really the primary contribution of this framework, and of course the large literature that followed up on it.
So I'll add a perspective that applies to the equity markets. The segregation of retail order flow from institutional order flow has largely by dealers who recognized that there was less adverse selection, less risk in the retail order flow, has had a huge impact on the markets. So the markets are certainly substantially more, I would say fragmented, but I really want to say segmented than they used to be. They've been brought together by various forms of arbitrage, but this separation of order flow has very substantially changed the character of the markets. And the SEC currently is proposing to further formalize it with the notion that perhaps retail orders should be exposed to individual auctions. So that proposal is quite interesting, of course quite controversial, but really interesting because it's the first time that the SEC is actually sort of codifying the segmentation of the market in this way. And I thought that's kind of interesting to comment upon.
I think that's, it's interesting that I think that's kind of parallel changes in the academic literature. If I go back to the 1980s, we saw a lot of microstructure focused on inventory models and that sort of thing. Now, my reading of it, it's almost all focused on adverse selection. And so that parallels the separation of the informed and uninformed order flow that you see.
All right. Of course, how information is processed by participants, especially intermediaries, has changed very substantially as we've gone from manual dealers to individual traders who were first using rules of thumb and now increasingly using artificial intelligence, statistical methods to identify their trading strategies. I find it really interesting how jittery they are, that in ways I would not have expected. The idea that they'll take a position and on the first sign that maybe it's not right, they jump out of it. So you see high-frequency traders normally offering liquidity, but very often taking it. So their make-take ratio is often like 40% to 60%, where you're thinking that these are dealers, but they're just always, always trying to get out or ahead, or maybe they're trading on small signals that they're seeing or something like that. I found that very interesting and pretty unexpected. What other sorts of things have you seen in the last few years that you think were surprising to the markets? Anybody?
Well, I mean, if you look at the, let's say, the latency arbitrage game, that is not necessarily there anymore to the extent that it was. The initial stages of the HFT participation and the very, very large profits that were available in the mid to late 2000s and early 10s are not there anymore. So there is more innovation and I think there is a misconception or perception of this, speed game that because you've got the movies, you've got the books, you've got the things that people have seen. I think the sources of alpha, if you want to call it that, or revenue generation are quite different now. There is more in terms of the absorption of information. You mentioned retail flow. Some of the very successful participants in the market in terms of profitability, they collate other pieces of information related to the equity price move, and it's much more work at the cross-section being done of this absorption of informational sources that will predict higher frequency type of dynamics in the next seconds, milliseconds, nanoseconds, but a much broader, relating again back to my point about technology, things that you could not calculate at those speeds even a few years ago. So looking at the options market and the cash equity market, looking at retail activity intraday or near the close versus next day's open, looking at news flow, how real-time parsing of news affects price moves. These are the types of things that have evolved quite significantly, coupled with the tools and the technology being in place to be able to assimilate this information and come up with signals.
You're all undoubtedly aware that people subscribe to electronic feeds of headlines. And then they have their computers read the headlines and draw whatever inference they think they can do out of it, either trading on the information or withdrawing from the market in response to the information in ways that individuals couldn't even imagine, all of this happening in milliseconds or less. It's pretty interesting.
Yes, because up to recently it was serious. It was a momentum versus reversion game based on pure sort of time series type of statistics, whether they're machine learning or statistics or whatever we want to call them. It's methods that we're all familiar with, but without these extra elements of information. It was purely a statistical artifact.
Yeah, I don't know what you mean by surprising necessarily, but I will say that there are certainly a lot of developments in markets over the last few years. You can put them in different categories. One important category would be technology, the fact that you have a lot of automation in the trading, the fact that you have new sources of data, big data, that are affecting the trading, and as we discussed, I think they are affecting the dynamics of the market. I think the other important category is regulation that is constantly evolving, and things like circuit breakers, for example, that we heard about earlier today, or occasionally restrictions on short sales and things like that are affecting the way that trade happens. So to some, these would be surprising developments in markets.
Now, I'm thinking about papers that greatly influenced my understanding of market microstructure. We'll talk about Pete Kyle's paper shortly, but I want to mention one that many of you may not be familiar with. But it was by Amahud and Mendoza, and it didn't even get published. It was a paper they had prepared for the American Stock Exchange, in which they introduced, at least to me for the first time, this notion of quote matching. The idea that people could make money by extracting the option values of standing limit orders. So you got a large order standing at 20, and if you step in front of that order and you're able to buy, the order's to say it's a buy order, you step in front of it and you're able to buy, then if markets subsequently rise, you'll make money. And if they drop, you'll try to turn around and sell into the standing order at 20 and bound your losses below, effectively obtaining something of a option-like return at the cost of the guy who wished that he traded if prices had risen and regrets trading if prices end up dropping. And that principle turns out to be super important throughout market microstructure. I learned a lot from that, and it's ultimately behind some of the innovations that have been seemingly strangest of all. So for instance, the ISE's fiber optic coil, in which they slow orders down by, 70 milliseconds or something like that. What do you guys think of that innovation in particular? So you got an exchange that managed to convince the SEC that slowing things down was worthwhile. I mean, what was the basis beyond that? Maybe there are other issues besides quote matching and stuff like that, but do you find you're using that or avoiding it? Michail?
Yeah, I mean, this is a concept that was even in FOR, like the original kind of approach to avoid this sort of adverse behavior of participants. It can be throttling, it can be multiple. So in Europe, for example, you have the periodic auctions. So you have a few seconds of the day where you just match orders intraday as you would do in a closing auction. You have innovation in the US. There's a pool called One Kronos that does the same thing 70,000 times a day. You have slowing down. These are all attempts to improve the toxicity of the venues that you interact with. And the balancing, the counterbalance to that is liquidity. When you do participate in these types of venues or using these types of approaches, the available liquidity is much smaller because the people that would provide that liquidity, which is a huge 60% of the market is high frequency market making, will step back. They will not participate there because there's no economic benefit to them doing that because the models that work at the nanosecond interval don't work anymore. So better quality of execution, many fewer fills. And this optimization of do I participate in a more toxic venue but higher certainty of fill and higher possible liquidity, not in times of stress, because very rightly, as you mentioned earlier, in periods of stress, they do step out and there is no liquidity, but in normally functioning markets, that is the balancing act that one has to perform. And there is no clear answer. It depends on the intraday, on the trading alpha of your intent, of your order. If you do need that liquidity quickly, you will take a slightly toxic, more toxic fill and consume that liquidity. If you don't, and you are a passive fund, you are somebody that is not time sensitive in their execution, you would use the more benign, let's say, venues that employ these types of methods and spread out your trade for longer.
Sort of a parallel line of research that I liked is the papers by Eric Budish and his co-authors, where they're calling for batch auctions, periodic batch auctions, as opposed to continuous trading. And that has the advantage of increasing liquidity because you don't have the sniping for stale quotes, and they also suggest that it might help to end the arms race of large expenditures to increase speed of execution and speed of the messaging, which really is just an allocation between market participants and doesn't really help in capital formation or anything like that. So they're suggesting batch auctions maybe every 100 milliseconds or so and not continuous trading. You may have some other problems if you have different exchanges doing batch auctions and the timing being a little off. You'd still have the arbitrage between exchanges. But it seems to be an idea which is worth more exploration.
Just to quickly build on that, I think the academic literature is still debating what is the optimal speed. I don't think everyone would say that we want trading to be as fast as possible. And certainly there are some disadvantages with high frequency and people who just build a lot of capacity to beat the other traders. I think this can be quite disruptive to markets. So, if you ask me my own view, I think the optimal solution is probably some interim solution. I wouldn't go to the fastest necessarily.
So it's worth talking a little bit about speed here. Many of you know the three needs for speed. If you are making market, you want to make before other people do so that you're ahead of the line. If you see an opportunity to take, you want to take before anybody else takes that opportunity away from you. And if you're making market and you decide you don't want to be making market, you have to cancel as quickly as you can to avoid being hit. And so these three needs have resulted in people basically in arms race to be the fastest, because being fast is not really all that important. What's really important is being faster than your competitors. And so people are doing all sorts of things to be very, very fast. And now the question is of what good is this to the rest of us? So there are, to the best of my knowledge, no capital structure decisions that are made on millisecond timeframes. I'm not even sure there are any made on 1 week timeframes. So when we think about large-scale capital efficiency issues, it's certainly not because we're producing information quickly on a millisecond basis. But we do know that capital is cheaper to issuers when the secondary markets are liquid. And these processes create liquid markets, and that's extremely important. So now how do we end the arms race? We heard one proposal. I have proposed that perhaps what we need to do is simply have exchanges randomize arrival times. So you get an arrival time, add a random number from, say, 0 to 5 milliseconds to the arrival time. So you got a modified arrival time, and then process orders in the order which, in the modified arrival time order. And in doing this, then you defeat much of the advantage of being microseconds faster than your competitors. And that would be a potential solution as well. So there's a lot to debate about this. But one thing that just keeps coming back is just how important it is to be first and the expense of it. The danger of having the arms race is that as it becomes increasingly expensive to keep up, the number of entities that are able to move so quickly declines, and we become more dependent on a limited number of people doing various types of services. And ultimately, that has the potential to lead to market power, which should be of concern to everybody. But otherwise, the arms race seems to be quite dissipative, but all competition is dissipative, right? You have...
Yes, my question would be why, in terms of trying to stop the arms race?
Well, so if it isn't producing any value to society...
but is there proof that it is not?
Well, so we're back to the question of how much additional liquidity is there when we're talking about 1 millisecond versus 2 milliseconds. And
conceptually,
if we can get more people to offer liquidity who are 2 milliseconds fast instead of 1 millisecond fast, we might be better off.
That's true, but I would say, would there be people that would be willing to offer a 2? Because the economic benefit to them would be diminished. So, and I'm not taking one side or another. I do like the idea of periodic auctions in high frequencies and cleaner operating markets. My fear is, though, that many of these participants would disappear, and therefore liquidity would be less, not more.
I mean, I think at the end of the day, you have to ask yourself, what do you want to achieve out of the financial market? Financial market is there to enable the exchange of assets and to have information come out in the process that can guide the allocation of resources. At the end of the day, if you have market participants that just focusing on trying to beat others, and this does not promote the ultimate goal, then I think we can view it as a waste.
Mm-hmm. But I would take a more, let's call it macro view, and look at the cost of trading in US markets now versus 10 years ago versus 15 years ago, and it is significantly lower. Spreads are much tighter. The cost of executing your orders is much lower than it used to be. So that is a net positive.
There's no question that the markets are much better. The question in front of us is, could they be even better? And so I would note that if reforms cause intermediaries to withdraw, they're probably withdrawing because of competition from buy-side traders. And so if the buy side can meet the buy side easily, it's because there's actually been a net increase in liquidity. And intermediaries, if they're not needed, why should we be supporting them?
That I completely agree with. If I could just trade with my peers and not have any intermediaries, that's the optimal outcome, for sure.
Yeah. Yeah. What other papers are you fond of that you think that you learned from or that have changed your thinking about the markets? We should talk, maybe it's a good time to talk more about the Pete Kyle's 85 paper.
If you look at fixed income markets, there's been interesting research there in the last few years. I think the work on dealer networks is particularly interesting. Lee and Scherhoff would be one paper that comes to mind, but there's a lot of research on networks more generally and that's applicable to how dealers behave in fixed income markets or other markets. And we see with, say, municipal bonds, we see a handful of central dealers in the center of the network. We see lots and lots of peripheral dealers who...
Disco ball?
Lots of peripheral dealers who trade with very few others. The central dealers trade with lots and lots of other dealers. The central dealers actually charge more. They take less risk. It's an interesting organization to the market.
For me, it's been my recent, more sort of area of interest has been on portfolio market impact. So Jean-Philippe Bouchot's work and work that I've done with Kostis Maglaras at Columbia on the concept of how portfolio level effects permeate markets rather than the individual stock by stock traditional sort of market impact work that has been out there. So that's
I think later on, I hope that we'll talk about some of the innovations that are coming that are related to that.
Yeah, I think the questions of market design are always fascinating. What would be the optimal mechanism for trading? And Paul mentioned the differences between fixed income markets and equity markets, the over-the-counter versus centralized exchanges. I think those papers are quite interesting, just trying to think about what will be the optimal organization of markets going forward. One thing that we are seeing these days that is quite fascinating, and I think there is a little bit of academic literature that is starting to develop, is what we see in the world of DeFi. And really kind of new designs of markets, automated market makers. I saw a couple of papers that are trying to rationalize this and think how liquidity is provided and whether it's optimal or not, or what are the trade-offs. But I think there is more to understand there. I would say in terms of experimentation, this is somewhere where right now we have a lot of experimentation. So it is possible that going forward, we will have some exciting developments coming from there.
I'd like to speak just a little bit about Pete Kyle's 85 paper. Most of us know it for its discussions of adverse selection, but I honestly think that its most important contribution is to our understanding of bluffing and of market manipulation, in particular the notion that dealers have to respond in a linear fashion to unidentified order flow, so anonymous order flow, because if they don't, they can be pushed into positions where people can extract profits from them. And I think that this insight is really important, and if you haven't recently read the paper, you may want to reread it if you don't fully appreciate that. I'm going to share with you another paper that you probably aren't familiar with, but which I found to be one of the most fun papers I've ever read in market microstructure. Is by Stephen Figlewski. I think it appeared in '82 and another one in '85 on the same line. So he asked the following question. If informed traders make money, and if they trade based on their wealth, so the wealthier they are, the more they trade, what implications does this have for the informativeness of prices? And in particular, it turns out that markets produce the optimal weighting of their information. So the weights, their wealths become, and therefore their trading is optimally weighted, so that if you had an omniscient actor who knew their information and wanted to do an optimal combination of forecasts, that combination of forecasts would be the same combination that results from an equilibrium where the better informed people get richer and the less informed people get less wealthy. And this is true not only based on the variances, but also the covariances among their information. So it's not a well-known paper, but it's a really pretty paper, and I recommend it to your attention. So. Guys, anybody want to talk about market microstructure invariance? I know Pete will talk about it a little bit shortly, but maybe we can introduce that. How important, I mean, do you think this concept is for our understanding of liquidity or market, of how to regulate markets even?
Yeah, with the invariance, we're switching from clock time, the way we normally think of time, to a renormalization of that business time, and we're switching our concentration from orders to what's referred to as bets or entire position size. And when you renormalize things in that way, it turns out that what looks to be very, very different across stocks and over time is really pretty much the same. So that's a very nice insight. Now, when I compare that with the 85 model, the 85 model is very intuitive to me, but in variance, as soon as you get cube roots, man, my intuition is gone. So that's makes it a little more difficult.
Yeah, I think I agree with that. I mean, I will leave it to Pete, of course, to talk about it afterwards. The 85 paper, as I mentioned in the beginning, I think gave a very clear framework for us to understand the underlying forces in financial markets and how information is reflected in price, what will be the ultimate liquidity. And I think the invariance framework, I think, is still being developed. So I think it's, there is still more room to go before it is something that is very intuitive to the broader community.
So having introduced the concept, the question, of course, you know that I have a strong opinion as well. I strongly recommend the paper to you. I actually think that it represents as great a contribution as the 85 paper. Here you have the following very simple notion is that trading involves solving a problem that's essentially the same for all markets, all securities, all contracts, that it involves the movement of risk from one person to another. And that the rate at which that happens may vary across instruments, but that ultimately market structure shouldn't matter that much. Of course it does matter, but as a first order approximation for understanding the gross character of how markets operate and the determinants of liquidity and of the, how information gets aggregated and so forth, that do this incredible regularity. And the most incredible part about it is that it has very hard predictions, as many of you who are familiar with the work know, for the certain exponents in functional forms. So we're expecting to see exponents of 1/3 or 2/3, or some with minus signs and stuff like that. And you got this hard prediction, and then you look at the data, and it's remarkable. I mean, there it is. I thought that was really pretty. So strong recommendation for that. We should turn to you and see what questions you have. I have many other questions, but let's make sure that we're addressing issues that are of interest to you. So what innovations in market structure would you like to talk about that we haven't touched yet? Pete.
Yeah, this is a question for everybody on the stage except Paul. So Paul wrote a paper about NASDAQ and the tick size, back in the 1990s. And Larry and the panel here has been talking about changes in market structure over the years. Did that paper contribute to the changes that we see in the market we have today that, as you've said, offers the lowest transactions costs we've ever seen? This is a paper with Christie.
So there's a long line of papers
Yeah.
on tick sizes and its importance for regulating relationships in the market. So the paper you're referring to is the NASDAQ paper, right? Yeah. So there was a tacit collusion story and, getting ticks to be smaller. And that it's an example of academic work that upset an equilibrium that perhaps never should have existed. And that was very, very influential. But more generally, the academic literature has written a lot on the importance of tick size because tick size regulates the privileges associated with standing first in line, and helps defend traders, or at least give traders some reward for offering visible liquidity. When tick size gets small, people don't queue up much. You seemingly get price competition, but people don't queue, and they'll split the orders into smaller pieces. They'll hide their orders, all in an attempt to control the exposure of standing options to trade. And so it's a very important determinant of market quality, and it's very contentious. The SEC, of course, you may know, has got a proposal now to regulate tick sizes, and so I think it's a very important issue, and of course, I mean, Paul's paper definitely changed the world.
Before I went to grad school, I mentioned I was a retail stockbroker. And one of the things that I learned as a retail stockbroker is that there's understandings about ways of doing business and conventions. Some of them are pretty simple, like, you don't poach your other broker's customers. And if you get shares in an IPO, you don't sell them until the underwriter gives the okay because the offering is completed. But I remember one time our trader was incensed because we made a market in a few stocks, and there was only 3 or 4 market makers, and it wasn't that actively traded. But a new market maker came in, and they came in with a higher bid than ours and a lower ask. So they were insider quotes. And our trader was incensed about that, and he said, that's not the way you do it. That's not done. You want to come in with a higher bid? Fine. You want to come in with a lower ask? Fine. But you don't come in with a higher bid and a lower ask. So, and he explained that as, this is business ethics. This is the way you do things. So when we were seeing lots and lots of quotes with no odd eighths, it just seemed apparent that this was an understanding. This is the norms of the way you do business. So that's where that comes from.
There have been a few other places where, we won't go through the entire list, but a few other places where academics have identified strange stuff that the SEC subsequently became interested in, which is a strong argument for ensuring that the academics have data to look at things, or at least that they go to the SEC where they can get the data and look at things. We have a question pending on my right.
My first question is, how common is it to see larger firms deploy machine or deep learning technologies in their trading strategies? And if it isn't so common, why is that? And the third question is, for smaller firms to be able to compete, would employing these strategies provide any opportunities to do so?
It's very common in the marketing material. It's quite uncommon in practice.
And
now
after
that I'm
this,
not there anymore, it is extremely common, but it's mostly for advertising purposes.
and next week I'm going to the audiologist.
Is it becoming more common?
Look, certain techniques, certain methods, which I wouldn't necessarily call machine learning. 25 years ago, I did my PhD in statistics. It was called statistics. So things have changed, and you have certain new tools out there to play around with a much bigger pool of data, and especially the non-linearities and the identification of non-linearities in market microstructure. Certainly, there are advances there, but they're not the be-all and end-all. They are techniques that allow you to get a slightly better outcome, especially unsupervised type techniques. In my experience, they constantly fail in markets. Even the most sophisticated techniques that I had deployed in the past, they needed the Bayesian approach and the overlay to constrain the outcome.
So I'll add just a little bit to that. AI, of course, is becoming increasingly important in our society, and so the question is, where is it going to have its greatest impact in finance? And so AI requires that the machine be able to learn, and where you have repeated problems over and over and over and over again, that's where the machine has the greatest potential advantage. And you see that in market microstructure, that people are just doing the same thing over and over and over again. But when it comes to sort of understanding human behavior that may change in response to what they have learned themselves, measured over cycles that may correspond to monetary cycles or national event issues and stuff like that, AI is not likely to be very successful. And so if you want to see where AI is going to be successful, you need to find places where things are repeated. So the next most repeated example outside of market microstructure and finance is probably earnings announcements. So earnings announcements happen over and over again. But even there, the context changes, and there are people learn from them. And so the question is, will computers learn how to learn about how people learn? That's a big mouthful, but that's what they need to do to be successful. And ultimately, the most clever among us are the ones who can try to figure that out. I saw a hand over here. So a microphone in the front.
Usually when we talk about market microstructure, we tend to be a little bit myopic, talking about US markets and talking about stock markets. So two questions. Number one, is there anything to be learned from microstructure in other markets outside the US? And then question number two, what about increased activity on options exchanges, and is there a spillover effect in either direction from stock exchanges to options exchanges or the other way around? And obviously related to that is the increased importance of retail activity on the options markets as well.
I think, I'll answer maybe the first question. I think the answer is obviously yes. we tend to look at the U.S. markets because they are the largest and deepest. But in cases where you have different designs in other countries, there is certainly a lot to learn from that. And one example that I can easily think of is the bond market. And there is this interesting feature that in Israel, the bond market is organized like the equity market, so it's centralized and you don't have this over-the-counter structure. And there has been quite a bit of work on that, trying to understand the differences between bond markets in Israel and in other countries. And I think there's quite a bit of insight coming out of that.
So we can broaden the question also to historic markets as well. So in the United States, bonds used to trade at the New York Stock Exchange in order-driven markets. And the technology was filing cabinets in which people filed orders. So this was a database that managed the order book. And Bruno B.A. and Rick Green of blessed memory did a paper and showed that the markets were more liquid then than they were at the time that he wrote the paper. Bond markets have recently become more liquid, but the idea that these markets were more liquid in the 30s and 40s than they were in 2010 or something like that should have rung a few bells, telling you that the structure perhaps wasn't nearly that the structure was more important than the technology, and how much better might it have been with current technologies. So, in the United States, we run very complex equity markets with inverted exchanges and stuff like that. Seeing that markets abroad or futures markets operate quite well without having such, complexity, maker-taker, taker-maker, stuff like that, is a lesson to us that says, frankly, we really don't have to do it this way.
Yeah, no.
Anybody want to go ahead and...
I completely agree. There are lessons to be learned. I mentioned periodic auctions earlier. There is evidence in Europe, since that started, that the quality of execution has significantly improved. So that is a way of operating a market that it doesn't happen here, and it could. You can go to closing auctions. There are very different ways that closing auctions operate elsewhere in the world. Here, that visibility onto flow 5-10 minutes before the close creates different dynamics. It's not clear to me that this is advantageous. So yes, there are many lessons to be learned. And then on the question on the options market, there's definitely a lot of information that can cross-pollinate. The difficulty there, back to the international example, is that the options market is very liquid here on the single stock basis, not so liquid anywhere else in the world. So that, to me, is it's a much more sort of US-centric experiment and way of looking at things.
Perhaps one of the most important themes that runs through market microstructure that's not well appreciated is the question of dealerization and de-dealerization. So left to their own devices, dealers will try to make markets into dealer markets. And so the options market in the United States have basically become dealer markets. They're held in exchanges because the OCC says that they will only honor contracts traded, they only put into the clearinghouse contracts that are traded on regulated organized exchanges. But dealers don't want to compete with other dealers or the public, and so they've created, I think we now have like 16 or 20 different options exchanges now, with many of those exchanges just dealer fronts where the dealer is the designated dealer, and the rules ensure that nobody really can compete effectively with the designated dealer. And then the exchange pays for order flow, and the dealer pays the exchange for the privilege. So really the dealer's paying for order flow. And then on top of that, these exchanges have created or the OCC, under the pressure from the exchanges, has created lots and lots of strike prices and lots and lots of maturity dates because in the name that this is what the markets want, but in truth making it so it's almost impossible for the buyer to meet the seller. So that's an example of dealerization. And the opposite is when we get organized markets that tend to consolidate, then the dealers end up getting driven out. And this is really an important theme to watch. We're running out of time. I want to turn to questions about what do we see as important future directions in market microstructure. Anybody want to identify something that excites them or they think is important?
Let me mention something, going back to what you said before. And it's not only the future, but what I think has been one of the big successes of academic microstructure research is its impact on regulation in the last few years. And I think that'll also continue going forward. It supported decimalization. Academic research has calmed down people about algorithmic trading. There's a close association between what we do as academics and what regulators are interested in. I think that's going to continue.
I talked about the automated market makers, which I think is interesting to watch and see what comes out of it, and if it comes out of the DeFi world into mainstream financial markets. I think that would be something interesting. We also touched on machine learning and this idea of machines versus humans trading in financial markets. You talked about what are the trade-offs. I think that will continue to be interesting going forward. There are some empirical papers that started to emerge talking about what are the advantages of having a machine. And basically, I think the main message that comes out of that is it's not a clear cut. There is a trade-off, and you're probably better off combining machines with humans. I think that would probably be one of the key areas to watch going forward.
For me, I'm very curious to see how the arms race that you alluded to earlier pans out. Because what I've observed so far is that it has led to increased alternative ways of people trying to trade. It ties in with one of your comments earlier that, ironically, with the markets being much more liquid, more efficient, many more participants, you also have an equivalent increase in block trading, in activity, people using outside the algorithmic space, outside the traditional way or the way things were going, in much more sort of risk and block trading in markets, which I find very interesting because the trend had been positively towards the electronification speed up to a few years ago. So innovations there are many, matchmaking type of participants and activities out there in the market trying to find this natural liquidity bypassing the HFTs and the market makers. And the other thing that I would be very keen to see is improvements in our market impact modeling. Like that's something that I feel has kind of stagnated in the way that we look at market impact. And if you look at the best possible R-square you can get of traditional models is like 2-3%. I'm sure there must be ways now with the plethora of data that is available to us to improve our thought process behind expectation of impact.
I'll offer two places to look in the future. First, the bond markets are changing. This is an example where we're getting some de-dealerization. Market X has become increasingly powerful. If you talk to intermediaries in the bond market, they just swear that bonds are different than everything else. And I've never quite understood that. I understand that they are contractually different, but a bond is just interest rate risk tied together with a little credit risk, which we know as So the interest rate risk is traded in futures markets. It's super liquid and exposed. Credit risk is traded in its purest form in the equity markets where there's lots of liquidity and it's exposed. I just don't quite understand how when you tie the equity risk to the credit, the interest rate risk to the credit risk, you tie them together and all of a sudden we have to trade them in dark markets where we're worried about all sorts of issues that maybe I just don't appreciate because I'm not a practitioner. But so I think we're going to see some changes there, and some of it's being driven by rules about the haircuts that dealers have to take when they're holding offsetting positions that essentially have no risk. Proprietary traders can get inside of that, and they're becoming increasingly powerful. The other place I would look for change is that we have lots of places where markets are redundant, where we're trading the same risks, sometimes packaged with other things. And mechanisms are emerging to allow people to move liquidity from one place to the other. The simplest of this that I find interesting is the CME has a way of imputing liquidity from 2 of 3 redundant markets. So the markets are, say, the near market in a futures contract and the next market and the spread between them. You've got limit order books for all 3 of these markets. And what they do is they'll take the best quotes from 2 markets and impute the implied quote into the 3rd market. What they've done is eliminate all calendar arbitrage. So the arbitrageurs have basically the calendar arbitrageurs have been knocked out of the market because the exchange itself is just doing it for you. And that's a clever innovation. There's lots of other places where you can see that happen. And related to that are the innovations where people want to trade large packages at the same time where there may be contingent instructions. And so you got to coordinate all the contingent instructions and try to clear that. And these end up being enormous programming problems, quadratic programming or whatnot. I think Pete's going to talk about that a little bit later. And so we may see some innovation in that area. So we've run out of time. I want to thank you for your attention and hope that we met and more importantly, exceeded your expectations.